entrepreneurs, Joe DiChiara, CPA extraordinaire, coming to you live from Metro Manila. And today, another segment of Learn to Earn. And today, what we're going to talk about, folks, is the LLC trap, the LLC tax trap. That's right. Here's the deal. Being a sole proprietor, when you start a business in the United States, you're automatically considered a sole proprietor. This is the worst possible way to do business for a number of reasons. Number one, you're overtaxed. Sole proprietors are overtaxed because sole proprietors get hit with a 15.3% self-employment tax on their net income. Number two, there are limited tax strategies. There's only a couple of tax strategies that you could actually employ as a sole proprietor as compared to a corporation. Number three, audit risk. Sole proprietors are audited 1,000 times more than corporations. How do I know this? You can't find this out by doing research. I know this because for all the CPA firms that I work for over 2 decades, it's 20 years of working with CPA firms. We're talking about tens of thousands of tax returns being processed, and this is how many of the corporations got audited. Zero. Now, a big part of that reason is because the returns were prepared by a CPA firm, but that's a whole nother issue. Number four, last but not least, is the fact that sole proprietors get little respect. When you go into a bank or an insurance company, try to get a policy, try to get a loan, you're not getting a business loan. You're not getting a policy based on what a corporation would be getting. Okay, so there's little respect. When you go for a business loan, an insurance policy, you're being treated as an individual. So what does that have to do with becoming an LLC? Well, here's the other problem with being a sole proprietor. You get no legal protection. In other words, your business and your personal assets are combined. You get no legal protection. In other words, if there's a problem with your business, if there's a creditor going after your business, they're going after your personal assets. Well, becoming an LLC solves that problem. It solves that problem. And so that's why many people decide to go the LLC route. They become an LLC thinking, oh, now I could do business. Why they do that is a whole nother story. But basically, when people do a search on the internet, they're going to be led to believe that being an LLC is a preferred way to be structured as a business. That's not true, and I'm going to tell you why. When you become an LLC as a single owner, you're classified as a sole proprietor for tax purposes. An LLC is what the IRS calls a disregarded entity. There is no special tax form for an LLC. So you default to being a sole proprietor. Now, if there's more than one owner, you default to being taxed as a partnership. Now, a partnership is in the eyes of the business community more it's viewed as a more advanced business structure because it's not just one person doing the business, it's more than one. The problem is partnerships in an active trade or business are still subject to the 15.3% self-employment tax. But there is a solution, folks. There is a solution. Even if you're classified as an LLC, you can elect, number one, you elect to be classified as a corporation. That's Form 8832. Now, there's time stipulations, which is for another day. But first, you can elect to be taxed as a corporation, and then you can elect to be taxed as an S corp. Being structured as an S corp is the preferred way to do business. Whether you're a single owner or multiple owners, most S corps are owned by one person. Why is that the case? Because S corps, the profits from an S corp, are not subject to that 15.3% self-employment tax. They're considered flow-through dividends. There's no double taxation. The corporation does not pay any taxes. It flows through to the individual. Lower audit risk. Like I said, corporations are usually not audited. Based on my experience, and we're talking about over 20 years, I'm in accounting for over 40 years, over 20 years working with CPA firms. So we're talking about tens of thousands of tax returns that I have seen processed, being prepared, submitted, and accepted by the Internal Revenue Service. Virtually none of those have gotten audited. Okay. The status of an S corp compared to a sole proprietor or partnership in the business community, the status is more respect. More respect. Now, you can't just, the naysayers, the accountants out there, if you do research, they're going to tell you, but a corporation has to pay a reasonable salary. Reasonable. That doesn't mean that all the profits need to be paid as a salary. So reasonable compensation is, there's no set, fast rule. It's facts and circumstances. Facts and circumstances. So you have more latitude from a tax standpoint being an S corp. That's my story. I'm sticking with it. I've been doing this for a long time, folks. If you have any questions or comments, please book a chat with me, Time with Joe. It's very simple. All I ask you to do to get a free consult is pick clients and students, which are for free. If you just pick the other one, you got to pay a $75 fee to meet with me. But I'm waiving that if you mention that you saw me on my live recording, even if you're watching the recording, the video. So that's my story. Good morning, Dak. Thank you for following me. Thank you for supporting me. and we're at 10 minutes. So I promised in 15 minutes or less that I would give you these valuable tips on business marketing, and today it was on taxes. So follow me on social media, book a chat with me, or just visit our website, which is bedrockbusinessbuilders.com. God bless and have a great day.